renewable energy, clean, inexhaustible, reliable, and resilient. By investing in AP, one of the country's largest providers of renewable energy, your dream of having a sustainably powered future becomes a reality. We are Powerhouse Capital, and we issue a buy recommendation for Aboitiz Power because of 3 points. One, AP has a solid foundation in the power generation and distribution business. Two, there's a favorable outlook as the economy recovers from the pandemic. Three, AP has strong financials to support prospective growth in energy and electricity demand. In our evaluation, we used DCF analysis and we found that AP has a 32.39% upside with a target price of 42.03 pesos.
AP, with investments in power generation, distribution utilities, and retail electricity services, is a well-positioned leader in the power industry through its wide customer base with a number of its affiliates across these sectors. With the challenges faced by the looming energy crisis in the country, AP is investing heavily in renewable energy, heading to its 2030 goal of energy balance between thermal and renewable sources. Heading to our first point, as a significant player in the power and utility sector, AP is the second largest power company, with 49 plant facilities in the power gen segment, 9 BU companies, 4 RES firms, and a subsidiary in distributed energy. In terms of installed capacity, AP was the second largest power gen company, capturing around 17% of the market as of 2022, on top of securing the largest installed capacity of renewable energy. AP is also the second largest in the EU, with some of the largest, such as the Visayan Electric and Davao Light. For RES, the market share as of 2022 was 20%. With AP's stronghold in power gen and DUs, AP is set to execute its 4-point growth strategy, including domestic market leadership through business growth and ESG, proactive response to the energy trilemma, heightened capex for renewables, and internal company growth focusing on human resources, CSR practices, financial health, and risk management. Now to our second point.
AP is positioned to seize the rising demand for energy in the country as the Philippine economy recovers from the pandemic. Given the recuperating GNI per capita and the rising energy consumption levels in 2021, AP is well positioned to capture the positive outlook in the Philippine energy market through its market leadership, with AP being one of the pioneers of RE in the country and having the largest capacity in the market. Opportunities in the power gen segment look favorable. The RE penetration in the Philippines is currently at 3% and 5% of the total generation and installed capacity respectively, generally lower than the ASEAN average of 5% and 11%. Thanks to a low RE penetration and robust requirements before capacity could be developed, Philippines is among the countries in the region that presently do not face challenges to accommodate the operating intermittent renewable capacity. With the Philippine government announcing its intentions to grow its RE capacity to employ a 35% sustainable power by 2030, AP is well poised to benefit from this ambitious plan as the government promotes international and local private investment in the industry, with AP transitioning to a 50-50 clean energy and thermal capacity mix by 2030 by increasing its generation portfolio to 9,200 megawatts. Now, to our third point.
We believe that AP will be able to achieve an estimated earnings CAGR of 4.62% from 2021 to 2026, with the expected increase in electricity demand of 5.8% CAGR in the next 4 years, alongside AP's expansion plans with an earmarked capex budget of 190 billion pesos for its clean energy portfolio. The company is expected to grow. This will propel AP's expected net income margin by about 15% starting 2023. Furthermore, in addition to cash flow from foreign activities, we expect that AP will continue to incur long-term obligations to finance its capex in the next years, which will be paid as AP realizes returns from its operations. We forecasted that AP's EBITDA will increase from 49.1 billion pesos in 2021 to an estimated 66.8 billion pesos in 2026 due to the sustained earnings growth trend across its power generation segment, seconded by the extension of its power distribution segment. As AP's long-term debts mature, we forecast a decreasing trend in the DE ratio of the company. Benchmarking shows that AP is highly leveraged compared to its peers in the same industry. This higher debt is attributable to AP's extensive plan for growth, wherein capacity is increased. The annual reports of AP show that it has been religiously paying its obligations on time. Thus, the risk of AP breaching and defaulting on its debt covenants is very minimal. Its rising net working capital of 36 billion pesos for the year end 2021, about 15 billion pesos higher than the previous year, indicates AP's increasing liquidity and may assist the firm's short-term financing in achieving long-term growth.
For the evaluation, the team used the DCF method, which best captures the growth drivers of the power gen, RES, and DU segment. We use a WACC of 10.36% and a terminal growth rate based on the Philippine GDP of 5.60%. In calculating our WACC, we use a risk-free rate based on a 10-year Philippine BVAL of 7.46% and a beta based on the adjusted 5-year covariance between PSEI and AP returns of 0.82. At current levels, AP shows a positive future based on the financial ratios relative to its peers. Its EV/EBITDA is only 9.13 times, well below the domestic and overall median, indicating that the stock is undervalued. This claim is supported by the low PE ratio of 9.48 times and a negative PEG ratio of 1.39 times. Furthermore, compared to its domestic, regional, and overall median, AP has a higher FCFF yield and ROE, which makes it more attractive. Looking at its 10-year EV/EBITDA bands, we see that AP is trading well below its historical mean. Even our forecasted EBITDA CAGR is closer to AP's historical growth, implying a better outlook for AP from the perspective of the market.
The top investment risks we identified are project execution risk, regulatory risk, commodity price risk, and interest and credit risk. Project execution risk from delays and inefficiencies can be mitigated through active stakeholder engagement, project insurance coverage, and periodic performance review. Regulatory risk stems from changes in laws or regulations involving tax rates, tariffs, subsidies, licenses, and climate response. This is addressed through collaborations with the DOE, IRC, and DENR, as well as effective management of the energy transition. Commodity price risk can be managed through derivative financial instruments, such as commodity swap contracts. Lastly, interest and credit risks can be mitigated by closely monitoring the cash position of the company and the creditworthiness of counterparties. Our sensitivity analysis shows that the 10.36% WACC should increase by 39 basis points before we change our recommendation to hold, and 94 basis points before it turns into a sell. Variations in revenue growth, consumption growth, and interest rate were also considered.
To further bolster our buy recommendation, AP propels its operations with ESG practices that extend beyond compliance. With the goal of having balanced energy mix and maintaining the energy trilemma framework, it primarily leads the industry by its environmental innovation through its installed pollution control devices and implemented resource optimization. AP leads in the social pillar through its zero gender pay gap initiative, and women employment is higher than its local competitors. Also, AP provides venues for employee development, minimizing occupational health and safety risk, and to ensure a safe and healthy work environment. Lastly, in its governance pillar, AP is adherent with best corporate governance practices. Members of the board and the senior management are experts across the industry with decades of experience. With level 4 risk maturity rating, AP has a clear understanding of its key risks and its consistent execution of mitigation strategies with periodic reviews. To note, power companies with high ESG scores tend to trade at higher multiples, but since AP has lower EV/EBITDA vis-a-vis its peers, despite its convincing ESG rating, indicates that AP is potentially undervalued and therefore a company that is attractive to invest in.
Now let's have a recap. We know that for one, AP has a solid foundation in power generation and distribution. Two, there is favorable economic outlook from the pandemic recovery. And three, it has strong financials to support rising demand. With a target price of 42.03 pesos and an upside of 32.39%, AP is your key to transforming energy for a better world. Thank you for listening, and we're now ready for your questions.